Module Overview. What is financial statement fraud? Financial statement fraud involves the intentional misrepresentation or omission of financial information to mislead stakeholders. This could involve inflating revenues, understating expenses, or hiding liabilities. Fraudulent financial reporting is a white-collar crime that can mislead investors, creditors, regulators, employees, and partners. This type of fraud is deliberate and different from accounting errors. Why do companies commit financial fraud? Pressure to meet earnings expectations, to attract investors or loans, to hide poor financial performance, to trigger bonuses or stock options, to meet debt covenants, to avoid taxes or regulatory penalties. Common methods of financial statement fraud. In this course, we will be using technique and explanation in our table. 1. Overstating revenue, recording fake or early sales. 2. Understating expenses, hiding or delaying expense. 3. Recognition. 3. Fictitious assets, adding non-existent assets to boost the balance sheet. 4. Off-balance sheet. Financing, hiding liabilities through external entities. 5. Round-tripping, creating artificial transactions to inflate revenue. 6. Channel stuffing, pushing unsold products onto distributors. 7. Manipulating depreciation, delaying depreciation to increase profits. Red flags and warning signs. Here are some common red flags in fraudulent financial reporting. A. Unusual growth or performance. Revenue growth without corresponding cash flow. High earnings inconsistent with industry peers. B. Aggressive accounting choices. Changing depreciation methods, often excessive use of estimates or assumptions. C. Poor internal controls. Lack of separation of duties. Limited oversight by the board. D. Complex or unusual transactions. Sudden related party transactions. Round numbers or inconsistent patterns. E. Behavioral red flags. Management refusing audits. Frequent changes in auditors. Delayed financial reporting. Ethical and legal consequences. In this course, we will be using consequence and details in our table. 1. Regulatory sanctions, SEC fines, license revocation. 2. Suspension. 2. Legal action, civil or criminal lawsuits, imprisonment. 3. Reputational damage, investor distrust, plummeting share prices. 4. Collapse of the organization, loss of stakeholder confidence, bankruptcy. Case. Examples: Enron, used off-balance sheet vehicles to hide debt. WorldCom, capitalized operating expenses. Wirecard, falsified cash balances and profits. Preventive measures and controls. To reduce fraud risk. Strong internal controls. Segregation of duties, approval workflows, regular audits, whistleblower policies, anonymous reporting systems, legal protection for reporters, corporate governance, active audit committees, independent board members, external audits, periodic reviews by independent firms, training and ethics education, staff awareness of accounting ethics, and fraud detection. Summary of key takeaways. Financial statement fraud involves intentional deception in financial reports. Common methods include revenue inflation, expense suppression, and asset manipulation. Red flags include aggressive growth, unusual transactions, and poor cash flow. The consequences can be severe: legal, financial, and reputational. Prevention requires robust controls, ethical leadership, and transparency.